We've seen this movie before with the stock market, and last time it happened, it ended in a complete bloodbath. What's happening right now is pretty much the carbon copy exact situation that was happening in 1980, and in 1980, it didn't look good for the stock market. You see, back then, inflation got totally out of control, interest rates shot up, and the stock market completely collapsed. And it wasn't just demand that triggered the stock market to crash, it was bad policy. And it wasn't just bad policy from the president, but most importantly, it was bad policy from the Federal Reserve. And today we're staring down the barrel of that same exact mistake, which is probably gonna happen all over again. So Trump's tariff policies are gonna potentially wipe out the entire global economy and put America on the brink of a massive depression, which we haven't seen since 1929, which could be the worst situation that anybody's going to see in this entire generation for their money, their stock market, and how they're going to see the future going forward for the world of money. Things aren't looking good right now, and if Trump implements these tariffs as imposed right now, I promise you the entire market is going to completely collapse. So Trump's tariff could set off a supply chain reaction that reignites inflation, and when they reignite inflation, guess what happens to the Federal Reserve? They then have to go raise interest rates to try to bring inflation down. And guess what happens when you raise interest rates? Typically the stock market's going to fall, and you could just go look at the COVID era to see what happened when inflation went up. The Fed had to raise interest rates to a crazy high level in a very, very fast way. Once they raised the interest rates, the stock market simultaneously went straight down. The NASDAQ went down over 35% in a very short amount of time, and this time is honestly probably going to be a lot worse than that. So this isn't fear-mongering. I'm not trying to clickbait you. I'm not trying to scare you. I'm not trying to get you to watch this video to the end. This is math, this is history, and this is a warning right now, so let's break it all down. So everyone's looking at tech earnings, the Fed, and AI hype, but few are zooming out to see the full picture. So right now I'm going to show you exactly what Trump's proposed tariffs actually mean and how that's going to lead directly to higher prices, and then why the Fed won't have a choice but to raise interest rates again, and most importantly, what that does to your stocks, your portfolio, and your future. This is critical to understand. So here's the setup. Trump wants to slap massive tariffs on every single import that comes into the United States, not just from China, but from every single country. And on top of that, he's trying to hit China even harder. And the Liberation Day tariffs that he did a few weeks ago, China is proposed at 145% tariff. That is pretty much an embargo, meaning that nothing coming from China could even come into the United States because the tariff level is so high it's not even manageable. And honestly, I don't think this is a bluff. He already called it the Liberation Day for the American worker, but here is the critical problem. Tariffs are not paid by foreign governments. They're paid by people like you and me. So let me give you an example. Let's say that Apple imports a chip from China with a 145% tariff. That $100 chip is going to be well over $200, and you think that Apple's going to eat that cost? There's no way they're going to eat that cost. They're going to pass it on to you and I, and your iPhone just got a lot more expensive. And it's not just going to be for your phones. It's going to be for cars, for clothes, for food. It's going to be for everything. So tariff raises across the board, that is inflationary. So now let's talk about this inflation time bomb. So right now we're in this weird feel-good stage where CPI inflation has come down, prices of gas feel stable, and food prices are decent and even coming down a little bit. So people think that we're almost back to normal right now, but tariffs are going to break that illusion. So what is the Fed going to do? They're going to have to raise interest rates to try to bring us out of this higher inflation environment. So even if the economy is a little bit fragile right now, even if unemployment's creeping up, the Fed has one job, and that is to keep inflation at 2%. And tariffs right now, this is what Jerome Powell at the Federal Reserve, he is losing hair over right now because he doesn't know how to properly manage this situation. Because think about it, if inflation's going up, you want to raise interest rates to try to bring inflation down. But you can't do that if the economy is slowing down because raising interest rates is going to weaken the economy even more. And then on the flip side, let's say that you want to cut interest rates to try to save the economy. If you cut interest rates to save the economy, then inflation is going to get out of control. And you could go look at any other country, any other collapse of any other nation. The collapse of nations usually happens because the currency gets totally out of control and inflation gets completely out of control. So the US dollar is the world reserve currency right now. And if inflation in the United States gets totally out of control, people are going to lose trust in the US dollar. And when that happens, bad things are going to happen. So let's be real. The Fed doesn't care about your portfolio. They don't care about the price of Tesla or Nvidia or Palantir or the S&P 500 or the NASDAQ. They care about their credibility and keeping inflation near 2%. So if inflation starts creeping above 3% again, especially from something structural like tariffs, they don't have the luxury of sitting around and waiting for this to pass over. They have to react. So what's going to happen next? Interest rates are going to go up. The cost of borrowing is going to increase. home mortgages got even more expensive now, and businesses are going to start cutting jobs, and the stock market, of course, is going to go down. And this sounds kind of familiar because guess what happened in 2022? This exact situation where the market went way down in a very fast period of time. And right now, I think this dip is going to be even worse because valuations of the market right now are a lot more expensive versus back then. So the market has more room to fall. When interest rates go way up, the entire valuation of the stock market has to come down. It's not optional, it will come down in value. Because let's say that you're valuing a tech company with earnings that are projected 10 years out. When interest rates are near zero, those future profits are going to be super valuable because interest rates are at 0%. But let's say that we jack interest rates up to 6%. Those same profits today are now worth way less, and this is what we call discounting future cash flows. And this is one of the best ways to actually value stocks and know right now what a stock should actually be trading at. So it's not a surprise that Warren Buffett uses this exact same logic to value stocks right now, and of course it's no surprise that he's worth hundreds of billions of dollars because it works. So stocks with super high price earnings ratio multiples, just think like Tesla or Palantir, anything with a lot of growth baked in, those stocks are definitely going to get hit the hardest, but not because the businesses are bad. It's because the math just simply changes. I talk about this a lot on this channel where money always wants to find the best risk-adjusted return. So if a bond is yielding 0%, there's going to be no money that wants to go into the bond because you're not going to make any money. Versus the stock market, which typically does 10 to 12% per year. Of course, you're going to put your money in the stock market if the bond is yielding nothing. But if the bond goes up to 6%, people are going to say, oh, the stock market is a little bit lofty right now. There's all this tariff policy stuff going on. There's these inflation things going on that I don't really understand. People are going to flock to safety and they're going to go buy bonds. And when they buy bonds, they're going to lock in that guaranteed 6%. And they're going to say the stock market, it's not worth a little bit more risk to just get a little bit more money. And here's the critical thing right now that really nobody is talking about. The stock market right now on the valuation level that we're trading at right now, it's priced in for interest rate cuts. Interest rate hikes are not even on the table right now. So imagine if there's a situation where inflation does materially go higher because Trump is very stern on these tariffs. Imagine if inflation actually ticks up and the Fed then has to go and raise interest rates. The stock market's going to completely freak out. It's going to be completely shocked and the stock market is going to fall quite a bit. So if that situation happens and we flip from interest rate cuts to interest rate hikes, you better buckle up because it's going to be very, very bad. So this is the blueprint for what's going to happen next in the stock market. And to understand that blueprint, we have to zoom out just a little bit. So the last time that we saw something like this was in 1980. So back then, inflation spiraled completely out of control, and Paul Volcker, who was running the Fed back then, he had to make a very difficult choice. He was either going to let inflation run wild or raise interest rates to levels that nobody thought were even possible. So he chose the second path. He raised interest rates all the way up to 20%. Right now, interest rates are 4.25%. He raised them all the way up to 20% because inflation got completely out of control. And you could probably guess what that meant for the stock market. Went straight down. Wasn't looking good back then. And you're probably wondering why. Like, why did the stock market have to go down because that happened? And it's because the cost of capital totally explodes. When businesses borrow money to invest in their business or just borrow money to expand their businesses, it's going to cost a lot more money because now you're getting a 20% interest rate versus maybe like a 5% interest rate or a lower percent interest rate than that. That is bad for business. And think about it from our side of the equation. Are you going to want to go buy a house with a 20% interest rate? Are you going to want to go buy a car with a 20% interest rate? Are you going to even consider putting anything on your credit card where interest rates would probably be like 40%? You're never going to want to do that. So when we spend less money out there in the economy, what does that mean for the economy? Less spending, that's not good for the economy. Boom, big bad recession. So we have to understand what caused inflation back then because there were three key things that are kind of happening right now. So number one is the oil shock, where the price of oil went completely out of control. And honestly, right now, oil is being stable right now, but it might not be like that forever. Number two and number three are exactly what's happening right now. Bad government policy and way too much spending. Doesn't that sound familiar? Bad policy, too much spending. Everyone's fighting right now about the big deficit. We have Doge that's trying to fix this deficit with Elon, but they aren't even able to do it because there's just too much red tape to cut through to try to really trim major things out of the government budget. Politicians love to spend money, but they don't have enough money coming in to be able to justify the money going out. This is exactly what's happening right now, and this is exactly what was happening in 1980. So I'm going to say this. I'm not saying that we're going to have 20% interest rates, but I will promise you, the stock market is not prepared for interest rate hikes right now. The market is valued for interest rate cuts. No one is even pricing into their base case situations for the market the interest rates could actually go up. No one's even thinking of that right now, but that is, of course, a possibility. And if we get even a hint that the Fed might raise interest rates because inflation is ticking up, the market is going to go straight down. So I know there's a lot of negativity in this video right here, and I understand it, but honestly, it's justified. The market is priced in for pretty much perfection right now. And if we don't get perfection, if we don't get interest rate cuts, if we don't get trade deals worked out, if we don't get tariffs reduced, if earnings of these companies don't hold up well, the stock market is going to fall because the stock market is priced for perfection. When you don't meet the expectation of what the market thinks is going to happen, the market is going to fall. So I know this video was pretty negative, but I don't want to get that confused with this. I am very, very bullish America in the long run, meaning I think stocks are going to go up into the long run. But in the short term, there are some red flags that are popping up right now. I'm not saying that I'm going to go sell all my stocks and put them all in cash. What I'm saying is this. There's some things that are definitely overvalued out there, but there's some things that are undervalued out there. And the key is to pick between the overvalued and the undervalued and capitalize on the undervalued stocks. The big tech and AI revolution is happening right now. And these companies like NVIDIA, AMD, TSM, Tesla, Google, Meta, Amazon, all these companies are going to capitalize massively on this big AI revolution that's happening. But some of them are very, very overvalued right now. Tesla's expensive, Palantir is expensive, but on the other side, I think that AMD is cheap, and I also think that Meta is cheap right now. So yes, these are all household names, but some are good companies that are very expensive, and some are good companies that are actually cheap. So you want to try to stay in a category of good companies at a cheap price. So you have to understand that, and you have to understand the risk profile in your portfolio, because there's so many black swan things that happen out of left field that we were not even looking at. And when they do happen, it's going to be out of surprise, and you're probably going to get smoked if you're over leveraged right now. Now, stock options, you guys know that I do a lot of stock options. I generate a lot of money monthly selling stock options. I am being very, very careful right now with my portfolio exposure to stock options, because if we get a dip, I need to be able to survive through that dip to then capitalize on the next bull market. And when we dip, I like to have a lot of capital ready to go on the sidelines that I could capitalize on the dip, so I actually come out stronger on the other side. So if you made it all the way to the end of the video, make sure you like and subscribe if you got value from this. And definitely go check out my stock options course and Discord. It's one subscription. It's going to completely change your life. You're going to see all my trades, learn my entire system, the system that scaled me to millions and millions of dollars and thousands of monthly cash flow. Many people have done this in their portfolio too. So click the link below, and I'll see you guys in the next video.